Target stock, ticker symbol TGT. This stock is down almost 30% year to date, underperforming the overall market big time. And there are many reasons why this company is having a hard time. But margins and theft are the two top concerns right now for Target, but also for the whole industry. On the 16th of August, Target presented quarter results where they beat on EPS but missed on revenue. For the upcoming earnings, all 28 analysts think they will miss the estimates. People love Target stock because of multiple reasons, and one of them being the dividend. And I understand why, with dividend yield at 4% and 54 years of dividend growth. So could this be the perfect moment to buy TGT stock? Well, I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does Target do? Target is a leading American general merchandise retailer, offering a variety of products across several categories, including beauty and household, food and beverage, home furnishing and decor, hardlines, and apparel and accessories. Most of Target stores are large, averaging more than 125,000 square feet. When we check the most recent results, we see that comparable sales was reported at minus 5.4%, and this worries me a lot. Target can increase the revenue by opening a new store, but you also want to see growth in the already existing stores. The physical stores decreased 4.3%, while digital sales decreased 10.5%, which is quite a lot. Target reported a quarterly operating income margin rate of 4.8%, which was more than 3 percentage points higher than last year's, driven by a higher gross margin rate. The EPS was 4 times higher than a year ago and above the high-end guidance range. This was a meaningful profit recovery from last year's inventory actions. Inventory at the end of the second quarter was 17% lower than last year, reflecting a 25% reduction. Given recent sales trends, Target lowers its full-year sales and profit expectations. Target now expects comparable sales in a wide range around mid-single-digit decline for the remainder of the year. And to be honest, this worries me a lot. Target is planning to invest 4 to 5 billion in the business, including new and remodeled stores, but also the supply chain and digital capabilities. And now that we know a little bit about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week, and also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Target Corporation is a 49 billion market cap company. PE ratio is at 14, which could indicate that they are undervalued right now. Later in this video I will show you my 3 price targets for Target stock, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 108 billion, and in this graph we see that revenue went up in the long run. But it is not always steady and consistent, and most recently it is coming down a bit. Over a longer period of time, margins are going up and down quite a bit as well. This is something to keep your eye on. And it has to be said that most recently it is increasing after a major decrease. EPS is following the same pattern as the margins and revenue, nothing really special to add here. Analysts expect that in 2023 the EPS will still take a big hit, after that it is recovering very nicely. So although 2023 looks really bad, the years after looks pretty good to me. For the revenue it is a pretty similar story, but with low growth numbers up until 2025. After that, it is expected to grow at low single digits. Return on assets is sitting at 6.6%, which is a really low number. Return on equity looks very good, and the most important number, return on invested capital, is sitting at 11%, which is a great number. But It's slightly lower versus the 5-year average, which is something that I don't like. Current ratio is at 0.83, which is looking pretty good. There's nothing really special to mention here. Right now Target has 19 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with total cash. Target has 1.6 billion in total cash, so they can't pay down a big chunk of their total debt. This is something that worries me a lot, especially since their debt is at an insane level compared to the cash position right now. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up and down quite a lot, and in the most recent years it was at a negative number. Again, this worries me a lot. Shares outstanding are decreasing, which is something that I do like. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're all talking about dividends anyways, dividend yield is sitting at 4%, which is a great number. Annual payout is at $4.4 and payout ratio is at 59%. I prefer 50% or lower, so right now they have 41% left in cash to buy back shares, pay down debt, do acquisitions and all other things. The 5-year growth rate is at almost 12%, which is a great number, and they increased the dividend for 54 years in a row, which is very impressive. And if you take a look at these numbers, the dividends paid since 2012, you see that Target did increase the dividends at double digit for a long time, and started to increase the dividend at a high rate again most recently. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. In here we see that over a longer period of time payout ratio is increasing a bit, which is something that I don't like. In this graph we see the expected dividends in 2024, 2025 and 2026. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to grow at similar growth numbers, which is very nice. Overall these dividends look pretty good to me, but how about the historical returns? I decided to compare Target stock with the overall market, in this case the S&P 500. On the 5-year chart we see that Target was beaten by the S&P 500. In total Target returned 44% including dividends, versus the S&P 500 sitting at 70%. On the 1-year chart it looks pretty different, with the S&P 500 having a 22% return, while Target is sitting at a minus 26% return. On the 6-month chart it is again Target stock with a negative return. This time it is around minus 34%, while the S&P 500 is sitting at almost 7% return. On the 1-month chart it is again Target stock having a negative return, minus 11% versus minus 2% for the S&P 500. So bottom line, Target stock was beaten by the S&P 500 in the long run. And most recently it is also not looking any good. So could this be the perfect time to buy Target stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 1, 2 and 3% based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 3, 3.5 and 4%, and for the free cash flow margin I'm putting in the same numbers. For the PE ratio and the price to free cash flow I'm putting in 14, 15 and 16. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now Target stock is at $107. I hit analyze and we see a lot of red numbers. We have a low price target of $71, we have a mid price target of $92 and we have a high price target of $117. To me the mid to high price target is the most justified here, indicating that this stock is in the middle of this range. My final conclusion on this stock is that I do like the business itself. They have a massive portfolio of stores and have a proven track record. but they reach a point where they are maybe too big to grow at high numbers, which is very typical for companies like Target. So the real value lies within returning money to the investors with dividends and share buybacks. From a dividend point of view, it looks almost like the perfect stock, except for the payout ratio maybe. From a value point of view, the stock has taken a massive hit in terms of stock price, but to me it is still not at a price that I'm willing to pay for the company. The price target range is $92 to $117 according to the numbers. So with a little margin of safety here, I'm aiming for a $75 to $80 range. This is also impacted by the next earnings results, of course. So for now, I'm skipping this stock since I feel that there are better deals out there. However, I'm keeping a close eye on this stock since the next earnings results could push this stock down even further. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.